All right, everyone, welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street for Main Street. If you've not done so already, give the video a thumbs up, like, comment, subscribe to the channel. Come find Jason on Patreon. Over 228 posts, premium posts, articles, and podcasts. Only $5 a month, guys. Get in on that. If you're interested in swing trading alerts, come find me on carnivoretrades.com for swing trading alerts and analysis. Anyways, let's get into it here. So, spiders. A little bit of a retrace this week and a couple of breakdowns on the books. Now, it doesn't look like much here. Routinely, it would just look like a pullback if we're just looking at the naked chart there. Just kind of a pullback there. But we broke some critical levels here. So the first one is this upsloping trend line going back to the October lows. And you see we broke through that there on Tuesday. And we're kind of just stuck inside of that range. So a little bit of a micro bear flag. But for me, the even bigger level here is the blue trend line right here that I have drawn in. And the reason why that's significant is because this is what we call an inside bar. So you have a power bar there. And then as long as price stays inside of that on a closing basis, usually you get a continuation to the upside. This Wednesday, however, we closed below that. And this bar specifically is significant to me because this was the Powell pump last Wednesday. So this was when the market, went on a sugar high and we gamma squeezed up through 400 and, eventually got all the way up to 410 the next day. But this was the pump on Powell basically saying it's likely that we'll, somewhat back off of rate hikes. And we've negated that completely. So that to me says that we have a bit of a breakdown on our hands. And what that says is that we're likely to, if we have any sort of rally or retrace, it's likely to result in a lower high. This was foreshadowed by the Dow transports. Again, last week and really the week before, what I've been hammering on with you guys in here every week, I've been saying, look at Dow transports. We have a move up, a high, and then a lower high versus, the Dow industrials, the high and then a higher high, or the spiders, high and then a higher high. When you see the transports start to show laggardship, it's usually a sign the market is in trouble here. In addition, another leading sector that we cover every week here, XLF, negated that Powell pump from last Wednesday on this past Tuesday. So we closed below that. We'll talk more about banks in a minute, but and because there's a lot to talk about with banks here, but you can see here the transports, they blew through that Powell pump and closed back below this trend line here. So Dow transports showing laggardship. That's never a good sign here. In addition, we had some other sectors, Russell 2000 here. Russell 2000 can be a leading indicator, right? Why? Because it represents risk. It's small caps, right? So if money is flowing in small caps, that's generally bullish. If it's flowing out, that means risk is off. We closed below that Powell pump and we closed below this pivot here. So really negating all of this rally here from the month of November with Tuesday's close, or I should say, yes, Tuesday's close. So problems here in the market. We're seeing some sectors start to break down. And, what does this mean? Again, it means that if we were to have any sort of rally off of the CPI, remember we have CPI next week, we have options X, we have a quad witching OPEX. We also, December OPEX is also a leap option OPEX, so that's a leap month. So there's lots of premium expiring. And then, of course, we have the FOMC. So to me, it's likely that if we got any sort of pump off of that, it would likely result in a failure, maybe a back test of this trend line, the 200 moving average, or possibly this trend line. But I at this point, it looks like we're not going to make a higher high. So that is what the market is telling me right now. The positives here, if there are some, is that the triple Qs have not broken down. So the triple Qs have not negated this green bar, and they've not gotten below this pivot here on a closing basis. So the triple Qs are also holding up, and very importantly to note, the semiconductors are also holding up. So you guys know I love the semiconductors as a leading indicator. And you can see we came down and we tested this green bar low 2 days in a row, and we actually, bounced off of that. So this pattern is still intact for a potential move up here. So the semiconductors and the triple Qs are your positives. They're really the best friend of the market right now. The other positive, if there is one, is the volume is pretty light. So we had a nice move up on heavy volume, and again, heavy volume and declining volume on the selling. So generally that's going to be a positive for, more upside. But if you ask me, I think we've had too many there's too many red flags. In addition to the spiders closing below this green bar, we also had the diamond. So the Dow Jones lost that green bar, the Russell 2000, the XLF, the Dow Transports. There's just too much technical damage done to key sectors, if you ask me here. So I think people are talking about a Santa rally. I'm not in that camp. Maybe we can, bounce back up, but I don't think that it results in any sort of higher high. So that's kind of the bias that I have going forward into the end of the year. As far as some other sectors, so we mentioned the semis, the transports. So I've been talking about the 15,000 area. I don't think that target gets achieved. That would be more of an outlier at this point, given the nature of how the transports have traded recently. The semiconductors, again, they are on the stronger side. So, who knows? Maybe they can push up to that 240 area. If we do rally, they could still make higher highs if they have not broken down yet. But if this breaks down, the market is in big trouble. So just be aware of that. Another sector that we cover every week here, cloud software via the IGV. This also closed below that Powell pump candle, and it also closed below this pivot here. So we have a big air pocket now in the IGV, big gap waiting to get filled there for cloud software. Take a look at CRM. This makes up a good portion of the IGV. This stock has been absolutely hammered here. Just bear flagging all the way down here on that weekly time frame. So not a really good look there for Salesforce. And that is dragging down the IGV. So be careful here with cloud. All right, on to interest rates. So TNX here, the 10-year, we had a little bit of a dip in the middle of the weekend. That 100 moving average was defended there. And you can see right at that 3.4 area, there was that previous, we got to go to a monthly here. There was that big megaphone pattern, right? And that's basically where we stalled out here and we got a bid. You can also see there's kind of this trend line up here. Maybe we could have a little bit more of a dip into it, but you're kind of in that range there, that general range. There's also this pivot high, this little kind of consolidation. So that's where the 10-year got a bid. I do have a buy signal on the 30-year though, as far as rates. So that would mean short bonds at the long end. So we do have a nice pivot here. Came straight down, oversold into that. And if we go on to a monthly chart, you can see this was your pivot here. There was a previous pivot before the big sell-off, and that's where we broke out. We had a pivot there, and we're basically back testing that. I do like the 30-year yield here before I move higher. Now, I don't know if it goes up to make higher highs. This could just be a short-term buy signal, but I do think rates get a bid here and at least get some type of a counter trend move. So I just want to make that clear. Speaking of rates, I want to show you guys just the yield curves here, just to visualize. I'm sure everybody hears about it every single day in the financial media. Yield curve this, yield curve that, but it's good to just visualize it. So if we go back to 2000 or 99, this is the yield curve. This is the 210 spread, and the white line is the parity. So you can see we went inverted there for about 10 or 11 months. I think it was 10, 12 months. And it really kind of just chopped around. And the same thing in 06 to 07 when it was forecasting the housing bubble collapse. But notice how, these kind of come down and then they just base here, and they base at the flat line, and then they correct. Look at where we are now. This is a massive inversion, and it's really not showing any sort of stop in sight. It's not like these previous two yield curve inversions where it went down and then it stopped and we kind of just chopped around. We went positive, we went negative, this is just in absolute free fall right now, and it's not showing any end in sight. Here's the 3-month 10-year. This one also as deep as it's been since 2000 and really 2000. So basically a 23-year inversion at this point, or very close to it. So there's major problems out here, and I'm going to talk about the banks in a second, but this is not good for those balance sheets. First, let's talk about home builders before we forget. So home builders also another sector that's holding up okay via the XHB here. You still have an up move and an inside bar here. You never closed below that Powell pump low, never closed below the CPI pump low. So XHB is also a stronger sector, as is the ITB. The only reason I can figure here is that yields have been kind of backing off, at least the last couple of weeks. So that could be keeping these names buoyant. You see the VNQ here. It's still consolidating and hasn't broken this green bar low on a closing basis. So it's still holding up. I'd be shocked if we got up to that. So remember, we have this inverse head and shoulders here. I'd be shocked if we got up to this target, though. I mean, it would take a lot of cooperation from the market. I can't rule it out, but I would say chances at this point are much, much lower here. So, but for what it's worth, the home builders are holding up okay. So they are a little bit of a stronger sector here going into the end of the year. Now on to banks. So this is a major problem. Probably the biggest problem for the market. I know everybody's focused on CPI. And by the way, we had PPI numbers come out on Friday, and that came out hotter than expected. And that spooked the market a little bit as that kind of pokes a hole in the inflation is peaked narrative. So we'll see what we get here with CPI. And then, of course, the Fed. The market's looking ahead to the Fed, obviously, next week. But if you're looking for a catalyst or a black swan, I think this has got to be it here. I'm hearing people talk about a Santa rally. Market's just going to go up into the end of the year. And I asked this question on Twitter the other day. If you are thinking of a Santa rally is coming, what's your price target for Bank of America for the end of the year? This is an absolute major breakdown. And let's take a look at Wells Fargo, Citi, KBE, large bank ETF, KRE. These are not patterns of strength. You have JP Morgan basically holding up, and it looks like to me that a lot of money flow is going into this to prop the sector up. Berkshire is being used to prop the sector up as JPM and Berkshire make up a large portion of XLF. But regardless, we lost that Powell pump bar last Tuesday. We lost this pivot later in the week, and now we're kind of bear flagging about the 200. I've been doing this long enough to know that when the financials just break down out of nowhere and there's really no news and the market holds up and nobody's really talking about it, there's serious problems ahead. So to me, everybody's going to look at, CPI could be the next bear catalyst. The Fed could be the next bear catalyst. I think this is the next bear catalyst. And I think it's a black swan. There's something wrong here. Again, like I said, I've been doing this long enough. There's something not right here. Credit Suisse is at all-time lows. It's off the lows a little bit here. They had another liquidity swap. I believe it was last week. It might have been on Friday. I'm not sure. But that was basically to get them off the canvas, and it barely did. They're going to have to do a reverse split soon if they can't get back up above $5. And from here, I mean, that's basically like a 35-40% move. You're at 337, $5. So there's problems here, and I think it might be FTX related. I know everybody's talking about the Bank of International Settlements, just the $80 trillion in derivatives that are at risk here. There's also 450,000. I believe it's delinquencies on mortgages. I read on Zero Hedge. I'll try to link it in for you guys. I'll pull up that article in the comments. But there's problems here. This is not anything good here. By the way, broker dealers XPD. This has been holding up really well all year long, and that lost that Powell pivot bar as well. And we had a weekly engulfing reversal. So I think banks are the next real problem here. That's just kind of what I'm looking at. Anyways, here, let's move on to energy. So crude continued lower this week again, back tested that 20 moving average and it's continuing down. So last week I'd said like the market maybe kind of near term worried about recession risk, and that's going to put pressure on crude. I do think it's coming into some pretty good support levels down here in the mid to high 60s. So we'll see what we get this week, and watch the yield. So I told you guys I have a buy signal on the 30-year. If this starts to, the 30-year yield, just to be clear, if this starts to move up and rates continue up, that's going to be a tailwind for crude. So we could have kind of a nexus here where crude does get a nice bid. So we'll be watching that moving forward, but crude, again, under a little bit of pressure this week. XLE, again, not to, pat myself on the back here, but I told you guys twice this year, do not chase this up here. And we're getting a pretty good sell-off in energy stocks. Take a look at XOP. That's wiped out pretty much all of that October rally. OIH with a big sell-off on Friday. That should have some good supporter at 260, 250. And I've been telling you guys it probably wants to go back there for a while. And, it's only $10 away now. So, again, these energy stocks, the trade's not over with, but I'm always against chasing things when they're just at runaway highs like that. So, always be patient. If you miss a move, trust me, the market will give you another chance to get in. Natty here, nice little rebound. I had a Decent buy level at 550. I did not get in on this, but it had a nice little rebound there, filled the gap. We'll see how it reacts next week. I still think it's a good chance to possibly go down and test $5. But for right now, I had a good rebound here. I wouldn't do anything with it at the moment, but it's holding up okay and got a nice little bounce here. Uranium. So uranium, again, that weekly inside bar I've been telling you about here, which is using CCJ. Big weekly inside bar. It's starting to play out a little bit to the downside. If these go into correction mode, I do have some levels worked out. And again, we kind of violated this trend line twice now. So we'll be careful with this right here. If this goes into correction mode, I do have some buy levels possibly worked out here. I'd say your really good levels around 16. But in the near term, you'll have good support at probably 18 there, maybe even a little bit at 20 in the near term. So we'll watch that next week. If we do, reverse somehow and close above that, it could result in a pretty big move, failed pattern there. Same thing, URNM. Let's say right around 55 and then 50 are going to be good levels. If you get through that, then $40. So we'll watch uranium maybe in correction mode here. But for right now, we'll have to see follow through to the downside next week to know for sure. Ag names. DVC had a little bit of a retrace this week. This should have good support at 22 if it can get down there. Then the potash names a little bit on the softer side too. So these may be doing some more backing and filling. MOS, NTR, both on the weaker side this week. And Intrepid is definitely on the weaker side here with a weekly inside bar there. So be careful with the potash names here moving forward. Dollar index. So dollar got a decent bid here. You can see we basically tested that weekly 50 moving average, and there was a little bit of chop here, so that's generally going to be good support. I think there's a better level at 102. I just don't know if it gets down there, but the dollar index I think will have another buy coming up soon. I'm just not sure if it gets really down to that level there, but it had a nice little bounce off of that 104 area. Again, I've been telling you guys for probably the last month or so, if it gets down here, you want to look to around 104. It should be good support, and it's holding up now. So we'll give it the benefit of the doubt, but it did have a little bit of a bounce. We'll just leave it at that for now. Gold. So interesting. Gold actually held up pretty well this week, and on Friday, you can see it was actually green here. Gold futures actually closed above the 200-day moving average on Friday, and that's with the 10-year green as well. So showing a little bit of relative strength here. You see GDX is holding up nicely. Doing a little bit of backing and filling. I think this can be bought on dips as well. I will say, just be careful with gold this week because we have OPEX, and you guys know the drill, right? So the red lines here, that's the monthly OPEX. And just take a look at what gold does every single time we get into that OPEX period. So they could give it the hammer next week. I would just be careful of that. And it has run up ahead of OPEX, so they could be bagging some FOMO longs. Just be aware of that. But gold's holding up okay. Silver actually exceeded my price target with that pop on Friday, but again, we got to be careful going into OPEX week. They might be using that little pump to dump it next week. So just be careful. And there is a lot of weekly resistance up here, by the way. So, we came down here, we chopped for a long time. We went up here and then we had a failed bull flag. So we went up and then we pulled back, right? It was kind of a flag. It failed. Now look at where we are. We're basically testing that area. So there's longs trapped in that area. When you get up there, they will turn into sellers. That's why I exited my silver longs in this area here last week. But silver held up nicely, so we'll give it the benefit of the doubt. But I wouldn't chase it at these prices. I would wait for a pullback or a correction. Platinum also holding up nicely. We have kind of a wedge pattern starting to build here. And interestingly enough, we have this upsloping trend line, which also kind of coincides with this one here. So maybe if we can come up here and then back test that, could be a good entry for a possible long there right around that 1,000 handle. But all things considered, platinum holding up okay, and I do like it moving forward. Eventually, this will get to 1,200. Copper here, basically kind of a sideways week. It got rejected at that 200-day moving average. The only thing I'd be careful with on copper here is you do have kind of a weekly consolidation here from this down move. If you get above this red bar high on a weekly closing basis, so 396, that would negate this to I would say that's negated, and you would go up to probably 420 pretty quickly. But for right now, that's the only thing I would be careful with there on copper. Anyways, over to Bitcoin briefly. Not a whole lot to talk about. Again, let's get over here to the Daily, there we go. So same thing as last week, really. So we had an up move, and now we're just kind of flagging inside of that. It's a micro pattern, though. It's not crazy. It's you're still inside of this big weekly down move. So short term, yeah, we could get a bit up to 18,000, maybe that 50 moving average, maybe even a pierce of 18,000. But big picture, this is still, just down, bear flag, 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 and now another bear flag. So I still have that, 11 to 12,000 target on it, probably over the next couple of weeks to months. So just be aware of that. Anyways, back over to the spiders here to wrap up. Again, just to reiterate, if we get any sort of bid here, I would be looking for a lower high resistance areas here on the chart on the spiders, 200 moving average, 400 whole round number, and then your bigger level is going to be this upsloping trend line. And I'm actually going to just show you the futures as well, just because I have possibly a better trend line there. So this is the ES, and you can see we had a rising wedge breakdown, but this kind of nexus right here, so this upsloping trend line is meeting the all-time high trend line. So that could be also an area to watch next week. And the 200 moving average is right in that wheelhouse as well. So those are the levels I'm watching here. A break of 3,900 on a closing basis sets up a trap door to the downside, so be aware of that. But we do have quad witching OPEX, so expect lots of chop, rumors, and volatility next week. Anyways, guys, I'm going to wrap it up here. Come find Jason on Patreon. Come find me on carnivaltrades.com. I'll talk to you guys all next week.